one of the biggest mistakes I see people make, and probably the biggest reason we turn away a lot of good deals, is solid foundation of the business, really good operator, overpaid, and therefore raising capital, getting actual term sheets on the lending side is super challenging. The operator could issue out 1 million shares and dilute everyone down to zero. Hopefully that doesn't happen. And I've seen on the flip side where the investor cut a check and they can veto every single decision because the check size was too large. Generally speaking, the whole market is going and trying to get inventory from like a buying or intermediary perspective. Like you have tens of thousands of prospective buyers. And then obviously, I think it's like 7,500 business brokers that want to support the sale. Not many are coming at it from the perspective of how do I help capitalize a CFO to take over the reins. Appreciate everyone jumping on. My name is Judd. I'm leading the capital markets at MainShares. And basically what I'm responsible for is all of the deal flow that we bring to our platform, and then consequently like deals getting capitalized. So I'm sitting on both sides, effectively working with a lot of searchers, operators, entrepreneurs, and then talking to investors pretty much anytime I have free time. So these could be a good amount of like owners that have had successful exits to small family offices, right? So we have some like more retail investors, and then we have some committed capital partners that are, doing million dollar.
So describe MainShares.
Yeah, absolutely. And I'll also, this time, I don't think we had a chance to go through an actual demo, but I'll show you what it looks like to actually invest on the platform or raise capital, and then also like manage distributions, financial reporting, post-transaction to give like a little bit of a visualization.
Okay.
But effectively what we built is a platform to raise capital or invest into mostly Main Street businesses on a deal by deal basis. So you're either directly investing into a deal, generally with an individual that's going to be operating as the CEO. Occasionally we'll have some independent sponsors where they're more just structuring, setting up the deals, management's already in place, and it's much more passive from an ownership standpoint. I'd say most are, I think we've had about 600 entrepreneurs apply through MainShares in the last year. A majority are going to be self-funded search, is probably where we have the most amount of overlap. So what we'll do is we'll work with them and either, as we're looking at structuring the deals, some lightweight diligence on it. Here's like type of questions that we would ask as they're, formulating and pulling together LOIs. A lot of it is to figure out like a path towards financing the transaction. So one of the biggest mistakes I see people make, and probably the biggest reason we turn away a lot of good deals, is like solid foundation of the business, really good operator, overpaid, and therefore raising capital, getting actual term sheets on the lending side is super challenging. So it's one of the things that will come in and say, okay, like if you're going to go up another $500,000, like here's the implications of doing so, right? And it's going to maybe be a little bit more challenging to actually pull together all the financing necessary. But the platform actually facilitates these transactions, right? So we have probably, I think we just passed over 100 million of capital on the platform. Is it all liquid at this very moment? It's always hard to say, but we completed in the last couple of months about like 6 transactions, about $7 million of equity has been raised, and there's maybe another half a dozen or 8 deals that are actively raising capital on the platform, and it's mostly just individual investments. So individual deals. We'll start supporting our first fund as well. So for the individuals that don't want to, because sometimes check size minimums are pretty high, if they want to have a more of a diversification approach, we're working with a few groups that are going to be raising, funds to about $10 million fund to allocate across, 10 to 20 checks as well. But right now it's mostly individual deals with sponsors that act as a CEO, and then we facilitate the transactions and we help create a little bit more structure, standardization, governance around these type of deals as well. So that is the high level. Jay, I don't know if it would be helpful. We got obviously a number of folks on here, persona wise, of owners to investors to searchers.
Yeah,
Can
go
you
with
give me
the
like the
yeah, go for it.
yeah. Yeah, what is what
Oh, the group.
yeah. It's hard to talk to
So
like all the different
yeah, we
perspectives.
have
Yeah.
all the
Yeah.
above. So that's one of the uniqueness about our group is that it's, part searchers, part owners who are also adding to their portfolio, and everybody
Okay.
here is an investor.
Okay.
So 100% everybody invests, and then some of the guys are already owned and they're looking for add-ons, and some of the guys are buying their first acquisition.
Okay. Perfect. That's helpful. Yeah. I would say it's relatively common, of course, for owners, and I think that's where we actually got our from an investing standpoint, probably like our initial base. So we started as a business brokerage, Club Beacon, representing the sell side. They have transacted about 100 small businesses. So it's relatively common for someone to have a successful exit. They jump over on the investing side, and now they'll circle back saying, "Hey, have a couple deals, looking to raise some capital, and we'll evaluate those, kind of go through our approval process. If it's something that we think we can actually help capitalize, and then I'll show you what it looks like to actually like raise capital on the platform."
Okay.
So super common as well. So maybe let me just jump in and show you, what the system looks like to give you a little bit better
But go,
understanding.
so aside from just the UI, just go through process stuff. Like someone comes in with they have a deal. They come to you when they have a deal. They come to you when they've already under contract,
Yeah,
or like post due diligence. And then how do you guys diligence them? What's your process? And then go through it.
yeah. So ideally, the deal is already under contract.
Okay.
It is when we prefer to get involved. But a lot of times, if you're, trying to figure out how to structure an LOI, happy to loop our team in just to give our thoughts of here's what we think that you can actually raise capital at. I'll go through like a pretty, and I can share this with you guys as well, like a preferred participating model. I think the idea,
Yeah.
and we'll do
Let's
this a
do that
lot of
one.
times. Yeah, we'll go through that as well, just from a high level. And then I think the idea is when I meet a lot of folks, we'll kind of go through pre-LOI as they're looking at a deal once or twice to be like, okay, here's how you can set this up. Because the reality is most folks are looking at quite a few deals. So you can happy to, ping me. I'm building out a team built out of like 4 people underneath me that can help with looking at deals, pre-LOI. A lot of times what's going to go into it is when a deal is already under contract is we'll like to see the SIM, historical financials, tax returns. A lot of times folks are going to share pro formas, pitch decks, teasers with us as well. And that's usually when they're jumping on and they're going to tell me the story about here's the business, this is my background, this is my plan of what I'm going to do, from a transition to full business kind of strategy, like high level. Here's how I'm thinking about it. Let me know your thoughts effectively. And that's usually at the point in time when we're also looking at running it through our model to understand what the return profiles look like. Now that we have, I think 6 deals been successful, we've seen a number unsuccessful, more so outside of MainShares, where people have come to us saying, "Hey, I've been trying to raise capital for the last couple months, unsuccessfully." But I think the reality is we've gotten a ton of data points on what has worked and what hasn't worked as well. And I think the goal is we're still early from that perspective, but you can see a future state where we can effectively be like a clearinghouse of here's what we know is going to work, especially as we like broaden the capital pool. So there's over 300, say, pretty active investors that are on MainShares, likely moving to like the thousands here shortly as we kind of like start scaling that up. But needless to say, if you need help on the LOI, happy to have our team take a look at it. And then generally from once a deal is right under contract is when we'll kind of do an initial analysis of it. but at the point in time when we actually list the opportunity at MainShares, it's usually after diligence is finalized, or you're at least through, a cash proof, and we have like you're feeling positive about the opportunity. There's not really any red flags yet, and generally speaking, term sheets are in hand from the lending perspective.
Okay.
Just so
due diligence is done, quality of earnings is done. You got a term sheet from the lender. Now they come to you. How do you underwrite that deal? What do you look for? What are the elements of a deal that you think is going to raise capital, or the deal that's not going to raise capital? What are the differences?
Yeah, absolutely. So I think there's three components to it. We look at it from the management background, and I can pull up a couple slides too. But high level management experience, the actual deal, and the alignment with the management experience, and then the structure of the deal are like the three biggest components that we're looking at. I think structure and setup can kill a good deal. To give you some examples around this is we recently started working on a couple larger transactions where SBA is just no longer going to work out. So SBIC comes in as a viable option. The reality is the way that a lot of those loans are set up is there's heavy cash sweeps, right? So it aggressively pays back that lender, at 75% of all free cash flow, which the reality is, people look at it and like, hey, I got $10 million of debt. I only need $2 million raised now. This all should make sense. But in those circumstances, what's going to happen is it's going to be very hard to pay back invested capital under a 5-year period, right? More commonly, it's going to be like year 7, 8. And the reality is we're seeing good transactions or good setup of deals have a payback period of 2 to 3 years, right? So as soon as you start going out, and we've seen that it's super challenging to actually raise capital on that, just because of the debt structure and the terms and the covenants around the debt and how restrictive they are. So I think when you think about, especially for larger transactions, those type of things can make a good deal, a fantastic operator, really challenging. And then the other side of it, I would say, is either highly aligned or misaligned. Is when you think about them, just for those who have bought businesses, I think a lot of people have really good relationships with the seller, and the transition plan is very mapped out. Obviously, you can do it from a financial component. You could have, if it's a equity roll, earn out, seller finance note, maybe it's forgivable. There's always components from that side. But I think the ones that I find that are that I would really like to work with is it's so clear of what the current owner was doing and what they're going to be stepping in as, and effectively where the gaps are. So I see this missed quite frequently when it's not very clear of what is exactly was the key employees management responsible for, and then what am I going to be doing when I'm stepping in. It's yet generally, I'd say, for the folks that are a little bit more novice, it's not as mapped out, not as thorough. It gets picked apart in investor calls pretty quickly when there's not a clear story, which then also makes transitionary periods significantly more challenging. The reality is you're not going to have 5 years. You could have 6 months, right? 4 weeks, whatever it might be. So I think that transition plan is super key as well. So those are just a couple things. We can kind of dive more into some specifics, but and then from a financial side of things, the reality is if you want to boil down a pro forma, the reality is understanding true cash flow, not just TTM. I'm seeing a lot of deals being priced off of TTM EBITDA multiples and not accounting for swings historically. I see people that are doing a better job of, I was working with a sponsor recently, and they had a commercial roofing company down in Florida. And then last year they had a killer year. I think it was up about like 35%. EBITDA was up. The reality is they just really dug into like, where did that revenue come from? And it was a couple big projects that had been in the pipeline for quite a while. So what I see some people will do is that they'll start their pro forma based off of that last year's EBITDA. And then they'll have their 3, 5, 10, whatever percent year over year growth on top of that. And I think the reality is it's kind of highly unlikely that that's going to be like the case. What they did is instead is they dropped back down to, they looked at it from the last 5 years and they used more of a weighted average EBITDA in, which is going to be the biggest driver for these return profiles. So I think like, this is one of the things that I'm always kind of looking for is like, first of all, really get down to what the true cash flow is. So being hypercritical from an add back perspective, maybe it's in the weighted average doesn't need to be like 30, 30, 30 or whatever it might be. It's more so, what is the likelihood that that is going to happen again? And I think you have to be asking the questions to understand why certain years were higher or lower, to be able to make that like true determination yourself. So entry price in or EBITDA in is going to be a huge driver from that. Growth rate, obviously, as well. I usually, when I'm looking at something initially, weighted average in, maybe 3% CAGR growth, no multiple expansion. And then I still want to see the deal pencil in providing, above 25% IRR returns. Even sometimes I think the reality is like the top line revenue year one usually for a lot of folks will increase, but their actual EBITDA margin will decrease a little bit, right? So that's not uncommon, and it's what we've seen across most of the businesses that have sold through Beacon as well. So I think taking some of those things into account when you're thinking about it from a narrative, from a modeling perspective, is very helpful. And that's something that we think about and we kind of push back on as well. I would say, if anything, we're maybe a little bit conservative in the way that we think about presenting models, maybe to the point where, investors are discounting it even further. But I think that's one of the things that we push on quite a bit, especially with, if I see something that's 10% year over year growth, it's a huge red flag for me, because I'm just, how are we actually getting to these figures? And instead have something that's tied towards actual objectives, goals, strategies. Hey, we're going to open up a new market. Like, what does that actually look like? Okay, we need an additional 10 cars. Here's going to be like the CapEx outlay, which is actually not going to increase our EBITDA that much for the first couple of years. But then we're going to start seeing the efficiencies in year 3. Okay, fantastic. So those are the type of things to kind of give a couple stories that we'll be looking for.
Okay, so essentially you're looking for, what kind of IRR are you looking for upfront, just to say, okay, this is going to work or not? And then you're validating how long it's going to take to return capital. And then you're validating if the cash flows are going to actually be able to return that capital and deliver those IRRs.
Yeah, exactly. So
and what's the minimum IRR that you've seen? Like the ones that you guys raised through, or the IRRs there? And what was the return on capital and a return of capital period and all that?
Yeah. So if you look at it from a pretty conservative perspective, I think it's got to be about 25% to get anyone really paying attention. I think 35% is usually the figure that I see most investors asking for. The reality is, though, is like, I think you have to, if you're thinking about it, hey, I want to, start investing into more deals, you can manipulate an IRR very easily.
Yeah.
Right. It's you make a couple tweaks and you can have it say whatever you want. So I think it's understanding those assumptions and being a little bit more critical on those. And then you have like your own price, right? Because like, if I go weighted average EBITDA, I could be 20% off of like the starting point. which could change a 25% IRR to 50% IRR. Right? If they can just sustain what they've done historically, they're going to be significantly better off. So what we've seen is, I believe one of the last ones is targeting closer to like a 45% IRR on their bull case, 35% on base case, and 28 on bear case. Payback periods, are reflective of that. I think one was just under 2 years. Another was at the 3.5 year mark. But what you also notice is like when you decrease the amount of leverage that you put on these deals, your payback period is naturally going to increase. So for SBA deals versus, there's a couple that we're working on that are, closer to 50-50 equity to debt, the payback period is going to be significantly longer. And then when you go all equity, of course, that's going to take a longer time to pay back invested capital, while your IRRs could still be fantastic. And that really depends on, what your strategy is and like your time horizon, of course.
Okay. So when a deal comes in, you're looking at the operator, you're looking at the match between the operator and the industry, you're looking at are you looking at the QOV and all the stuff that they've already done? Okay.
Yeah.
And
so it's like, we'll usually ask for QOV if it's not, most of the time I'd say almost everyone is getting QOV. And we have a couple of partners as well that will do like cash proofs with just pulling. It's pretty slick via software. I don't know if anyone has heard of CredX Advisors. If you're looking for a fast, quick cash proof, they're fantastic. They basically pull GL, so general ledger and bank statements, and they can reconcile on a cash and accrual basis. So for you folks that are running like smaller transactions, especially when it's maybe the books aren't as clean as you would hope, it's a great group. But yeah, usually after that point in time, and we're going to be basing off of the QOV.
Okay. And then what is your process like? So what are your, how many of these do you accept? How many of these do you reject? And what have you seen like the reason why you reject these deals, if any?
Mm-hmm. So there's, and this will be helpful to explain. There's like two processes of raising capital through MainShares. One is self-directed, and I'll show you what the software looks like, where folks are effectively using our ecosystem in our software to run a capital raise. And then alternatively, we have a broker dealer that gets very involved, from diligence to structuring to sim and teaser creation, and they're actually effectively acting as like a buy-side advisor in calling investors to share opportunities. So that is much more hands-on service. We're in the trenches.
So like, for example, if I get an email from MainShares about a deal, that's coming from your broker dealer side?
It'll say brokered by Main Street Securities.
Okay. So it'll say, okay, got it. And in that case, you've done due diligence on the year-end numbers and all that?
Yeah, it's probably like usually it's like a 2 to 3 week due diligence cycle. So it's very robust. I think there's like 70 different documents. They're looking at like contracts, they're looking at employment agreements. Yeah, I mean, it's
so you're diving in
deep. Yeah. And
Okay.
it's investor related diligence. It's not like quality of earnings type of diligence. It's more, and it's obviously, it's a FINRA requirement with the SEC to be able to solicit these transactions, is to be able to map out risks and be able to actually run through that. So I would say usually it's going to be like the larger transactions, more complex in nature. A lot of times and we're working with more like operator personas and doing some like management buyouts as well. And that's like a swim lane that we're kicking up right now. So a few like absentee owners with, GMs, presidents, how do you capitalize $10 million? They'll come in and kind of help full circle of here's some debt providers, and then tee up the investors as well.
How about partner buyouts, family member buyouts?
Yeah. We're starting to do more and more of the, or we're like starting to kick those off basically. So like some of like the relationships we had at Beacon as well. What I've found is obviously from a transition perspective, it's highly aligned, and generally speaking, like the whole market is going and trying to get inventory from like a buying or intermediary perspective, right? Like you have tens of thousands of prospective buyers, and then obviously I think it's like 7,500 business brokers that want to support the sale. Not many are coming at it from the perspective of how do I help capitalize a CFO to take over the reins of the business. So it'll be really interesting. We've already gotten some positive feedback as well on that. So back to your original question, yeah. So that was these two different approaches. I would say like some of the reasons I'd say that like probably the biggest reason that we're turning deals away. The reality is we're not really supporting smaller transactions, right? So we're not running into as much like key man risk, because generally speaking, these, I'd say at 3 million enterprise value is probably on the lower threshold of something that you would see. But that is definitely like key to it. Not all in, right? So folks that want to be more, unless like they're willing to be more like independent sponsor economics, and they're taking like a carry on this, we'll usually like push away and turn those type of things back if they're not going to be boots on the ground working at running the business. So then from that perspective, it's looking for strong backgrounds that align with the business that they're looking for. It is definitely critical. The biggest, but by far the biggest reason that we'll turn things away is that we start getting deeper into the weeds, and we realize that it's overpriced. The CapEx considerations haven't been accounted for. It is a big one when you actually start diving into, okay, like you're going to get accounts receivables. You find out that half the accounts receivables are actually bad debt. You're actually never going to get that amount, and then you're going to have to increase the amount of capital that's needed. That makes things challenging. I would say people aren't accounting for maintenance capex for capex intensive businesses as frequently. So little things like that will trick it up. But I'd say at this point, it's mostly around pricing and getting deals under contract. I would say like as soon as you're above like a 5x multiple on EBITDA, I have seen very few of those deals actually make it to the finish line for whatever reason, from a debt, from an investor perspective. I've seen probably 2-3 dozen not. But
got it. All right, so you want to walk us through the platform?
Yeah, absolutely. Sure. So basically what I'm going to show kind of like both views flipping back and forth. On the right side, this is what it's going to look like from someone that's raising capital. So it's basically like the admin that they have on the back end. Left side is the investor view. So, yep. And so part of the onboarding process is collecting this information. It's effectively like a teaser, right? So if you go and you create an account on MainShares, and we are only running 506c transactions, so you have to be accredited in order to invest on the platform. But if anyone wants to create an account after, they can see the active deals. There's a couple different ways you can engage with entrepreneurs. First is a lot of times when people create an opportunity, they will host a webinar. So we'll send out new opportunities, webinars. You can request introductions directly, meet with the operators. And then you can also, there's also like a Q&A function. So if you just have like one question and you want to get a better understanding of this one thing, if it's true, fantastic conversation. If not, and we're seeding out a process to be able to like embed all of these Q&As so you can see what other investors have asked about the deal.
That's
Yeah. So first page is just going to be, this is pre NDA, engaging with the actual entrepreneur. So you'll see that like the deck, the data room, the offering docs, these are all blocked. On that note, we do provide form investment docs. One of the things that I've noticed is just like looking at operating agreements is they vary quite a bit. So our goal is to make the process easier. And one of the things that I'm driving towards is, if there's 10, 20 opportunities on MainShares, like how can I quickly do an apples to apples comparison, decide what I'm actually interested in. And then, at the finish line, our goal is to push more folks to use our form docs to make the process easier to actually understand, okay, what are my like limited shareholder rights, protections? How is distributions going to be handled in an exit scenario? How are my shares going to be priced, and what's that process going to be? You'll have like an overview. You'll be able to see background on the leadership team. This is where you can pose questions, a little bit of background on like where they're at in the raise, the actual sources and uses. And then this is just some investment details into the class, the rights, the frequency of distributions. And then we'll probably soon next year start doing bookkeeping and tax as well for companies. Right now it's, connected through like an API onto the back end, which I'll show you what it looks like. Almost everyone is going to be using our investment management platform. So one of the things is when we did a lot of like research, spoke to hundreds of investors. And I think one of the common aspects of the space is that there's generally limited like visibility, especially post-transaction, where the more common, I hear this all the time, is like I maybe get a K1. I do get a K1. It's generally late, and I get an email. I'm year 3 into this deal. I put $250,000 in, and that's pretty much all I get. So what we built out on the back end is you raise capital all the way from the accreditation process to the capital call and the Form Ds, and then investors are onboarded to MainShares to handle the distributions, the financial reporting, the consents, and then soon more IR KPI type of stuff.
It's like a Juniper Square type.
Yeah, a lot of
platform.
similarities to it. Yeah. Let's say, okay, I'm interested in this deal. Request access. Refresh on this side. So these go directly to the operator. This is Jill. Get a grant access. Now everything's going to come pre-populated. This is demo environment, so I don't know if I've seeded in the data room or offering docs, but it's just like a box pull up where you can download the supporting documents. We don't require specific information to be in the data room, because the reality is this tool is everyone has a different approach on how they want to raise capital. Where I've seen some folks will have wildly robust data rooms, and others will keep it relatively slim, and it's more request basis. So you'll probably notice a kind of varying degree depending on the approach and style of raising.
Well,
I think it could be also.
How are you going to be able to do the comparison apple later if you don't have all the docs?
Well, but it's funny. It's a good question. I would say like the apples to apples comparison that I'm trying to get closer to is like, first of all, just the key information about the deal, right? So what's the multiple? What is the terms? The model, I think, is probably a huge one to push more folks to using the same one. That because I think that's probably one of the more time-consuming things, and when folks will send me models, just to like break down to make sure they're even being calculated correctly, it is a component there. So we'll usually provide like our form pro formas, so then you can at least quickly change a couple assumptions that you see fit, and understand what return profiles look like.
Do you have an example there? Can you share like an example?
Yeah. I'll pull one up.
Sure.
But yeah, no, from like, because I've seen data rooms where people have had hundreds of documents, right? And I think that's, and
No.
it's pretty overkill, and I think it's also like what's most important, and is a little bit different for everybody. But I don't know. What do you think, Jay?
No, I get it. I understand. Yeah, it's
Yeah,
a very,
yeah,
it's a
yeah.
spectrum.
It's a spectrum, yeah. But the full process, I think the idea is like, let's make it easy on both ends, right? So I want to make a commitment. The accreditation process happens directly in app. For our broker dealer deals, we have to do KYC and AML as well, but that's also integrated through. I went through this process, took me 5-10 minutes. And we're like building out a closings tool as well. But you'll be able to actually commit to deals. A lot of times people will, maybe they'll have like more of like an IOI. If they have their, finalized commitment letters, then this would happen just via a box sign, which then is transferred over on the back end. And now we have almost like a CRM to manage all investors. If it's on MainShares, or, hey, I have a good conversation with someone and I want to like invite them to actually move through to close, right? So I get seated in. There we go. Judd, and invite via email, copy a link. So let's put their first name, last name. It'll create their account, so then they can actually go through the accreditation process as well. And then you'll have all my active, not interested individuals like revoked access. You have access. There's access control as well. Restore accesses for folks if you need to. And then kind of the last component is most of the interactions are directed by investor reaches out, requests access. But folks can also, we usually have like 15 or 30, maybe scale it up to 30 requests, and they can see MainShares profile. A lot of times they're LinkedIn's. This would be a popularity, of course, if it wasn't just this demo environment, and can individually invite Lisa to the opportunity as well. And then one last thing is post-transaction. Now we have, it's onboarded to the investment management side, obviously creating on the cap table, inviting all of the stakeholders. We'll issue them like the digital certificates. And then this will be like kind of like the source of all of the transaction data. I feel like the big component here is what we've noticed, is the waterfall calculations and the distribution handling can get a little bit cumbersome. So we'll actually set all these up. Obviously, financials can be published on, if it's a quarterly, yearly basis, any type of documents that you're sending out, consents as well. And then lastly is like distributions. But this is all connected via, like, investors connect their bank accounts. They can have multiple bank accounts, and it's ACH wires, which gives us a little bit better visibility into if payments have actually made it through. So we'll have full archive of all of the historical transactions. You kind of see quarter over quarter what's been distributed out. I think what this moves into eventually is more of like a modeling tool. So you can understand, okay, if we were to forego distributions, what's the implication of the pref, not being paid out and accruing over time versus, okay, if we paid back this last, $200,000 of invested capital, now all of a sudden, the amount of money that gets distributed to each share class changes substantially, of course. So a lot of this is still being expanded upon. So like right now, it's mostly around the financial reporting, distribution handling, but you can imagine this will be quite robust.
Now,
That's just the
essentially you're looking at it from an operator standpoint, trying to raise capital. We've gone through the whole process. They've raised the capital. Then it's just a matter of like executing and communicating with investors. Now, when you look at it from the other side, from an investor standpoint, how's that process for them, and how do they make sure as they go through deals within the platform to make sure that they're due diligence in these deals correctly and asking the right questions and looking at the right things within the deal?
Yeah, sorry, I got cut out for a second. So the question was, how do we ensure investors are asking the right questions?
No. Like how do you, like from an investor standpoint, what is that the right path to a good deal? So within your platform or within your view in general, as they're looking at underwriting deals, looking at deals, what are some of the things that you're seeing now that sometimes investors don't pay attention to, or they should be paying attention to make sure that they're executing on the investing in deals that are actually gonna deliver the returns that they're expecting?
Yeah, I mean, a lot of it from like an actual deal financial standpoint, it's not going to be much different than if you're looking to buy a business, right? So all of the same characteristics, like you are highly aligned from the way that they should be set up. So like I don't think that's much of like a different story of what you need to look for per se. I do think that what I'll see sometimes is maybe like the structure of the setup isn't as highly aligned, um, or it's trying to think of a good example of that. One of them could be around the process, so a lot of times you'll see like a call or a put option put in place, and call option would be on the operator saying like, I'm going to buy out your shares. Put option is reverse at a set point in time. Where I've seen things be maybe less like investor friendly would be around how that's actually determined, right? Like, what is the process of determining what is the valuation of the business is something that I think, and then also if there's a call, like we just added in put options as well, right? So like if I can call out investors, there also should be a point in time for liquidity to happen for me based off of an IRR or a time period, right? So there's little things like that. Or what I've seen is, evaluation is the usual way it plays out is valuation is kind of set on both sides. If you can't come to an agreement of what the business is actually worth based off of multiples, then it goes to a third party valuation shop. But who determines who that shop is, right? There's some shops that will definitely be lower and some that are going to be pricing higher. So even just like, and I've seen it go as far as two valuations and then it's the average between the two of them. So it's equal, right? So there's little things like that where I think it's areas where can be maybe not a great situation for investors, and I think they miss that sometimes. So I think the rights and protections, and I can share after, common governance terms that we usually have included that we'll, generally push for. I think the reality is those are usually being drafted very very far into the process.
Yeah,
right? So it's almost like
very late
super
in the
late.
process. Yeah, and that's the challenge.
You're already like almost in on the deal, and it's kind of here's the sign, and then all of a sudden these terms. Like I saw one recently where like the operator could issue out 1 million shares and dilute everyone down to zero. Hopefully that doesn't happen. And I've seen on the flip side where the investor cut a check and they can veto every single decision because the check size is too large, right? So the reality is like, and one of the things that we're trying to do is just make it more clear of like, okay, here are my rights, here's my protections. And I think that's part of like the apples to apples comparison. It's like, what am I actually agreeing to, and how is all of these decisions being made? So I don't need to go to an attorney and be like, okay, is this fair? Let's redline it. It's not really worth most people's time to do that unless they absolutely love the deal. So I think around like the rights and protections are usually things that I see a lot of investors getting frustrated around. So that's, that can be around, okay, how do you determine when to do distributions? A lot of times the way that we think about it is there's like a minimum excess cash peg, right? So, and maybe that has to be redetermined every year as the business grows, right? So at all times we need $500,000 to operate this business. Everything above it will be mandatory distributions to investors, unless the majority of Class A votes that, that it's, we can use that cash to hire 5 employees and do X, Y, and Z with the capital, right? But it has to go through the consent process to get the majority of Class A on board with. And I think some of the things we're building out on the platform side is to, move folks towards actually running consents, the limited shareholder rights that were like originally agreed to in the subscription agreements. That's just, an example there.
Got it. So what have you seen the guys that were successful at raising capital do differently than the ones that are not successful? Aside from having the right deal, having the right, structure, or maybe there's something unique about their structure that it makes it so attractive that they raise the full amount very quickly.
Yeah, I mean, like, even for the folks that I have seen, like Nick Hashka, for example, I don't know if he's at Club Investments, and he's had multiple very successful exits. When he comes to market, he's still friendly from a term standpoint. Like he's not aggressive on it. So like, I think people get caught up in the weeds on trying to save, a few percent, and they're unsuccessful.
What does friendly mean? So what are some of his deal structures?
I mean, they do. I'm not going to explicitly explain all these deal structures, but I think it's, for example, like majority of preferred participating with a step up on an SBA deal, like 2x step up and 10 to 12% pref is what people are looking for.
Got it.
Then they'll fight over 1.75, and they're basically fully levered, right? They're not putting that much principal into it. They're raising a lot of capital. The outcome for them is they're still walking away with the majority of the business. If it's 75% versus 80%, people get held up on that, and they're not. It's just so. And I think the thing about it from like what I think people do successfully is they're very, very upfront with the risks, and that is one of the biggest differentiators I've seen because it's not only like here's the risks of the business, but it's also like here's my game plan on like mitigating all these different risks. So the reality is no one is expecting a 35-40% IRR return without risks. So if you come forward and you don't have like a risks and mitigants section and like spend a good amount of time on it, it either shows you one of two things. Like one, you're hiding something, which isn't building trust, or two, it's you missed it, right? Which is even worse.
No, you're not thinking about it.
You're not thinking about it or haven't thought about it, and you're gonna have to deal with it later. So I think that's one of the things. So like the transition plan, risks and mitigants is huge. Like if I don't see that in a deck, it's a massive red flag for me. And then also like probably from like I think like growth strategies and things are good and all. But I'm more keen on how are you going to sustain where the business is at today? And like almost like having that story has got to be way more sound, right? Like that could be down to your employee retention strategy, right? Like, you have folks that will be buying businesses that need key licenses, and then they have an employee. That employee leaves, the business is kaput until they find another person with a master electrician license. What is the strategy going to be to keep that person that's been working there with 20-year-old owner still happy and motivated? And then I think that really comes down to like understanding, especially for anything that's like more project based, contract based, is like understanding where those customers came from. And I think you really have to pull on some owners, because I think reality is you start talking to them and they're like, well, it's a little bit of this, a little bit of that, like hard to gauge, right? So like
Yeah.
really drilling in where those customers came from, so then you can understand how do we can continue to repeat it versus these kind of high in the sky plans to 5x a business. I think they're good, but you can miss out on ensuring that the business
Yeah, it's
stays
interesting.
around. And
I'm doing this right now with one of our acquisitions, and I'm going through the list of the last 2 years customers and going from the
yeah,
top, from revenue to the bottom, and literally going one by one, asking the seller, how do you find this customer? How do you meet him?
yeah,
And then what I'm finding now, there's concentration in the referrals. So even though the concentration is not in the clients, the referral base is very concentrated. So like say the top, maybe of the top 10 clients, 5 of them came from one referral partner. And
yeah,
then, and so I have to make sure that, I'm good with that referral partner, so those referrals keep coming back. The good thing in this world is that the clients they're coming back. So, which is they know the business, so they're kind of detached from that referral source. But it's good to kind of understand the dynamic of what drives the growth in this business, and
yeah.
make sure that those relationships are taken care of and well maintained. Guys, if you have any questions, please feel free to unmute yourself. Anyone raising capital or wanting to invest in deals? Once you go to you said that you had like a prep model that you wanted to show.
Yeah, I mean, I don't know if we're gonna have time to go through all of it. You want me to pull it up? I
Yeah.
mean,
Yeah.
yeah, okay. I'll click through it quick, but yeah, it's definitely.
I always like to see different models.
Yeah, so effectively you got your assumptions up top, sources and uses, and Chicago line, exit. I always match exit multiple to entry multiple, and then it's effectively just a pro forma, right? So this is why the entry EBITDA is so important. You can also look at like what happens, it's down 50 would be quite a bit. 5%. And this is where we'll like start stress testing certain things, especially around, let's say one of the more common, you have your DSCR, as well as when you have maybe like a seller finance note that's on full standby for a couple of years, making sure that there's enough cash to be able to pay that back on the 5th year or whatever it might be. It's kind of a common misstep. The full debt schedule, mandatory cash sweeps, different types of seller finance notes, and then this is effectively like where the return profiles are coming in, with the actual waterfall structure. So the different tiers. All right, so this is for preferred participating. We'll also see like MOIC hurdle approaches as well. I think the percentage that goes at each hurdle it varies quite a bit depending on the deal.
That's pretty good because I never liked the models with 15 different tabs. This is like a
we just dropped it.
2-tab model with the same on the same tab. So that's good.
We messed around with it quite a bit.
Yeah, that's good. Okay. Any part of the process that you want to kind of share, that's something that new that just start popping right now in the last 12-18 months that you're noticing more of, or anything new to this particular time?
Anything new to this particular time? Pretty broad.
Yeah. Well, listen, we've gone through low interests, free flowing, lenders lending like crazy. Now rates are up, things are tightening. We've gone through investors having a lot of cash to invest. Now it's tightening it up. We've gone through periods where people were aggressive with their returns. Now they're tightening up. So what have you seen lately, and what's happening right now in the market? You're in it. So what's happening right now in the environment?
Yeah. I mean, I think in the environment, I've said it multiple times. So people are wasting time overbidding on deals and not getting them done. It's I would say so common where we'll kind of share our thoughts. I don't think this is feasible, and they'll circle back 3 months later that it didn't work out. So I think like pressure is to
do deals,
to bid, right? Like to bid higher. And then the reality is folks don't know where their buy box is, and they're just not able to get them done. Versus like, I think you got to push back and know where your buy box is, put in the offers at those prices, and it's surprising that that you will still win deals. Like brokers will make it seem like it's wildly more competitive than it is, and then people will get these offers under contract and not be able to finance them. Yeah. I think also like from an investor side, like with the expansion of like deal flow, right? Like there's a lot of different, investor lists, MainShares, right? We start, introducing, new capital and things like that. I think it is competitive as well, right? So like the reality is like one of the deals that we were working on, or this is relatively common, is someone came to us is like, I have 2 million soft committed. Probably 30% of the cap table from where they started to where their close was the same. So basically the reality is what happened is they had soft commitments, and then they found other deals that were better, right? And the time period in between then and close, they said no. So like reality is I think right now you definitely need a lot of different approaches and angles and relationships, and you can't think that everything is just gonna come easy from that perspective. I've seen very successful capital raisers have a tough time, and others they were able to move relatively quickly, but they had to refine process down, and it's even down to like, okay, you have someone that's interested, here's a subscription agreements, sign the subscription agreements, and like actually bring it to the finish line versus delaying that, which then inevitably you don't have them locked in. So
you make it, your goal is to have them sign subscription agreement and then collect the capital, or like wait until you're about to close and then just collect?
Yeah, you still wouldn't do a capital call until
you're about to close. Got it.
Yeah.
Yeah. Okay. Just get them signing something that they're committed to. They're already committed.
I mean, most people just will take soft commits as like, I'm in for 50.
Makes sense.
Yeah.
Cool. Well, I appreciate it, Judd. Thank you for doing this. We gotta record it, so we'll share it with the group. I'm sure you're gonna get some signups.
Fantastic.
Cool.
Thank you, Jack.
Thank you, everybody. Thank you, guys.
Yeah. Bye.